Let me ask you a question. Do you trade based on luck or on knowledge? Because for those who don't truly understand the markets, trading is nothing more than gambling. Most investors start their journey with the dream of quick profits, instead of trying to understand how the markets work. Unfortunately, this is why most of them fail. If you are aiming for lasting success on this path, it is essential to understand the fundamental principles of the markets. In this video, we will build the knowledge base you need to feel confident in your decisions while developing your trading strategies. After all, it's impossible to stand behind a trade if you don't know why you're making it. So, how do the markets really work? It's actually much simpler than you might think. Everything is structured around an auction system. In this video, we will explore the mechanics behind the markets by examining auction market theory. Financial markets have a single purpose: to facilitate trade between buyers and sellers. Prices move up from the bottom or down from the top through an auction process. And this process continues until it finds a point of equilibrium where the most buying and selling can occur. Let's consider an example from our daily lives. The price of produce at a local market. During the summer months, when produce is abundant, prices fall because there is an excess of supply, and buyers don't need to pay a premium. However, in the winter, that same produce is scarce, and prices rise. This is because demand remains the same while supply decreases. In the markets, prices are determined in exactly the same way, based on the balance of supply and demand. Auction market theory helps us understand this natural balance and better grasp how markets function. This theory is based on the idea that financial markets move up or down due to imbalances between buyer and seller aggression, which are triggered by market events. The price continues to move until it finds a level where this aggression is balanced and the maximum amount of trade can take place. We call this level fair value. Auction market theory guides us in understanding how this balance is formed and how prices are determined. At this point, you can think of buyer and seller imbalances like a balancing scale. On one side are the buyers, and on the other are the sellers. If buyers become more aggressive, meaning they want to buy more, the scale tips in their favor, and prices rise because increased demand pushes prices up. Similarly, if sellers become more aggressive, meaning they want to sell more, the scale tips in their favor, and prices fall because increased supply pushes prices down. Fair value is the point where the scale is balanced. It's the level where buyer and seller imbalances are resolved, and the market reaches equilibrium. This balance is maintained unless a new market event changes the aggression of buyers or sellers. At the core of understanding fair value lies the normal distribution curve. Normal distribution is a statistical model showing that the majority of data points cluster around the average, while extreme values occur less frequently. When viewed from above, this curve is shaped like a bell, and the range within one standard deviation from the mean contains approximately 68.26% of the data. Since this area contains the majority of a dataset, it provides a foundation similar to the concept of fair value. The volume profile applies this bell curve concept to market analysis, but orients it horizontally. It visualizes the trading volume at different price levels, presenting in a horizontal histogram which prices saw the most trading activity. On most trading and charting platforms, the price range that contains 70% of the total volume is defined as the fair value area. This horizontal graph can be thought of as a side view of the normal distribution curve. It also shows that prices trade within this range most of the time. Fair value represents the area where the market's buyer and seller aggression is balanced and where trade is most efficient. This concept is critically important for understanding market dynamics, both theoretically and practically. A security is considered to be trading at fair value when buyer and seller aggression are in balance. This is identifiable when prices trade within a narrow range on high volume. However, market events like economic news or corporate earnings create imbalances. These imbalances push prices away from fair value and initiate a search for new buyers or sellers. This process is called price discovery. Eventually, prices reach a level that attracts new buyers or sellers, which balances the previous imbalance and establishes a new fair value. Through price discovery, markets continuously cycle from balance to imbalance and back to balance again. During this process, in balanced markets, we trade in the opposite direction when prices move away from fair value, assuming they will return. This approach is known as a mean reversion strategy. However, In an imbalanced market, we trade in the direction of the trend. Why? Because the imbalance can create a strong trend in the market. In short, mean reversion in balanced markets and trend following in imbalanced markets. This is the fundamental principle of auction market theory. For these strategies to be applied effectively, the roles of market participants are crucial. There are two main types of participants in the markets: intraday participants and other timeframe OTF participants. Intraday participants provide liquidity but do not directly influence the market's direction. They think in the shorter term and aim to profit continuously by capitalizing on small price movements. At the end of the trading day, they close their positions and end up flat. Other timeframe participants, on the other hand, operate with longer-term strategies. They analyze daily, weekly, or monthly trends and work with large trading volumes that determine the market's direction. They are the main forces that shape the market and determine the long-term movements of prices. While intraday participants capitalize on the volatility created by these major players to aim for short-term gains, the other timeframe participants take on the primary role of steering the market. The dynamics between these two groups are key to understanding both the short-term and long-term movements of the market. Now, let's look at a concrete example of balanced and imbalanced markets. Let's take Amazon stock. The stock generally trades around $185. In this price range, the market is balanced, meaning supply and demand are in equilibrium. While the stock trades at this level, the current price is considered acceptable by both buyers and sellers. Intraday participants provide liquidity to the market to profit from these small fluctuations. For instance, they might buy when the stock price drops to $183 and sell when it rises to $187. However, the situation is different for the major players, the other timeframe participants. Since they accept this price range as fair value, they don't make significant changes to their positions. But things change when a development occurs that can disrupt the market's balance. For example, let's imagine Amazon announces a major breakthrough in its AI division that is expected to significantly boost future profits. This positive news would cause investors to see a higher future earnings potential for the company, and demand for the stock would increase. The major players would start buying aggressively, and the stock price would quickly rise to $200. At this point, the market becomes imbalanced, and a search for a new equilibrium begins. Prices rise rapidly, creating an upward trend. This trend continues until new sellers enter the market and balance the buyer's aggression. This is the characteristic feature of an imbalanced market. Now you have learned the fundamentals of auction market theory. It's time to apply this knowledge to your trading. Before every trade, ask yourself these questions. Is the market balanced or imbalanced? Are buyers or sellers more aggressive? Where is the fair value? The answers to these questions will guide you in choosing the right strategy and making more successful trades. Understanding auction market theory is an important start. However, to make it truly useful, you need to use tools like market profile and volume profile. These tools will play a critical role in your analysis of market balance and imbalance. In our next videos, we will examine these tools in detail. Stay tuned, and please don't forget to like and subscribe. Thanks for watching.